Get started. I do hope you enjoy the session. Nishant and Liz, I'll hand over to you.
Well, thank you so much, Holly, for getting us kicked off. Liz, very nice to see you again, and thank you for joining me this morning.
Yes, great to present with you today, at least virtually.
Yes, it's been a while since we've done this in person.
Yes.
But, I am really excited about talking to you about today's topic. As you know, that over the last 15 to 18 months, the world has looked very different. There's been a lot of bad news out there. But interestingly, as you know, I have been seeing a lot of inquiries, a lot of interest from a number of unincorporated businesses in New York. So think about asset management firms, think about consulting firms, in some cases, legal firms, accounting firms, who basically have been operating out of New York City. And there seems to be an opportunity to save on New York City UBT taxes. So this has been a topic that's been of interest to me. I've served a number of clients over the last 15 months, but I've also noticed that there's a lot of confusion out there in the marketplace as to what is New York City UBT, how is it apportioned, who gets involved. So I'm really excited about this conversation. Hopefully you can help bring some clarity to this topic today. So I'd like to, for the benefit of everybody on this call, I'd like to kick off by asking you, what is New York City UBT? Can you provide a quick overview?
Sure, Nishant, and thanks. And I'm happy to talk about this topic as well. I have to say, of all the sort of different New York and multi-state tax types that I deal with, UBT I find the most interesting in some ways because, as I'll talk about in a little bit, there's not a lot of sort of guidance out there, but lots of people don't know a lot about it and kind of get caught in its web, so to speak. So let me just say, it's New York City has several entity level taxes imposed on businesses that are engaged in a business, trade or business in New York City. So the UBT in particular is imposed on any kind of unincorporated business, and that can be a partnership, an LLC, and unlike a lot of other business taxes, also single member LLCs, sole proprietorship. So pretty much, anyone who's engaged in a trade or business in New York City that's not incorporated. It's imposed only at a 4% tax rate. So most people think, 4% tax, what's the big deal? But it's a very broad-based tax. It does have some very important kind of carve-outs, exemptions, if you're, purchasing or we typically say trading for your own account. So that's why, in the asset management business, we often see, one entity that is trading for its own account, it receives the carry, and then there's a wholly separate entity that is the management company. There's also a carve out for holding, leasing, and managing real property. But outside this, it's a pretty broad-based tax at that 4% rate.
Okay, thank you. And then, there's also something called New York City GCT that is applicable to federal S corps. Can you help just demystify the GCT, versus the UBT?
Yeah, absolutely. And obviously today we're going to be speaking, mainly about the UBT because when we're talking about, investment managers and that kind of world, most of them are organized as partnerships or LLCs. But there are some that are organized, especially on the management side, as a federal S corporation. And so New York City has what's called the general corporation tax. It used to tax, the GCT used to be applicable to any corporate entity doing business in New York City. But then as New York State did corporate reform in 2015, New York City sort of followed suit, but only for federal C corporations. So New York City doesn't recognize the S election. It doesn't recognize that it's sort of flow through income. It also doesn't care about whether you made the New York S election or not. all that matters as far as what is the taxable regime is whether there's a federal S election. So this is, again, an entity level tax. It's at a much higher rate, 8.85%, and kind of follows, you know, as I said, kind of the old New York City, New York State corporate tax regime of having a capital-based tax, an alternative tax base, and then a, you know, minimum corporate tax. There aren't the same exemptions that we see with unincorporated business tax. I should also say, both for UBT and GCT, we have this concept of, you know, business income, so entire net income at the 8.85% rate. We also have this other concept of investment income, which is, and again, I won't get into it, but when we're talking about income from investments in, you know, securities, right? That is taxed at something called the issuer's allocation percentage, which really just measures the presence in New York City of the issuer of security. So New York City, you know, has some odd concepts, taxing concepts that we don't see in many other areas. But for our purposes today, we're really focused on that business income that's taxed, whether it's a federal S corporation or an unincorporated business.
That is an awesome overview. Thank you so much. Hopefully we've gotten the audience a little warmed up here. I'm seeing some questions come in the Q&A, so I'll try to incorporate those in our conversation, our discussion here. So please, I encourage everybody to please send in any questions that you have so that we can talk about that either as we go along this conversation with Liz this morning, or we come back to them at the end. Also, some folks have been asking if they will get a copy to the link, and I believe the answer is yes. We will be sending out a link to the presentation, I think either today or tomorrow once the webinar is done. So you will have the slides. Okay, so now that we know at a high level what is New York City UBT and what's New York City GCT, can we talk about some of the apportionment, especially, as you know, Liz, New York apportionment rules are 3-factor. I don't think that's the case for UBT. Can you help folks understand how does apportionment work for UBT versus New York State?
Yes, because that's very important for our purposes. And often when I'm talking about New York State and New York City taxes, I like to point out where, you know, lots of states have the same apportionment regime for every entity type. Here in New York State, New York City, we like to have a different regime for just about every type of entity and differences between New York City and New York State. So when we're looking at New York City unincorporated business tax and general corporation tax, we look at apportionment or sourcing that business income only based on a single receipts factor. So we don't have the 3-factor formula of property payroll receipts like we see for New York State taxation of partnerships and LLCs. We also don't see, other than for sales of tangible personal property, we don't look at where the customer is. So for both UBT and general corporation tax, we look at, since 2018, a single receipts factor, and we look at, for services, where those services are performed. Now, before I kind of go into what that means in the New York City guidance, let me just say a couple of things. First of all, don't look at the New York City UBT regulations. For whatever reason, New York City changed its law for UBT as far as sourcing and looking at where the services are performed way back in, I think, 2007. It has never updated its regulations. I have no idea why, but in any case, it's identical for UBT and GCT where the services are performed. The second thing is, as we'll kind of talk about as we go on, there's very little guidance in the UBT context of how we determine where services are provided. So we ought, because the rules are the same as with GCT, we often look to the GCT regulations and some case law, which I'll get into with regards that interpret GCT law and regulations for guidance of how to interpret those same rules under the UBT. Okay, so as I said, for service providers, it's where the services are performed. And so it's to the extent that, services are performed in the city. So we'll have to get into what that actually means when we get to looking at a particular service provider. But a couple of key things, that is, lots of people ask, okay, what if, some services are provided outside of New York City, but we only have a New York City office. So obviously that's going to come into our discussion when we're talking about what happened during COVID when everybody left New York City. You don't need any other office other than your New York City office to apportion within and without New York City. It's just where the services are performed. Now, I should say for UBT and GCT as well, there are some special carve-outs, special rules for registered broker-dealers, for services to registered investment companies, that is based on where the customer is located. But those are very narrow carve-outs. So for the most part, when we're talking about, asset managers, investment managers, we're generally looking at where the services are actually performed. So I can kind of give you a little bit more detail. As I said, there's not a whole lot of guidance for New York City, but there is, some. There's a finance letter ruling. This was actually, there were multiple single member LLCs that the individual owns. So the one UBT return that reports the income of flowing from all of these single member LLCs. It was kind of an IT maintenance consulting company, and the requester of the letter rulings said, how do I figure out how much to income to apportion to New York City? And what the ruling said, which is consistent with other guidance in the GCT context, which is, it really gets very granular. If for, sort of each receipt, each client, if there is work being done in the city and outside the city, you can look at actual time that you're spending in the city and outside of the city. And that kind of hints at something we'll talk about in a little bit, which is, this is really a fact-based inquiry, something that requires you to kind of figure out how much time, how much of those services are being performed in the city, and may require, so in this case, the finance letter ruling, right, we had 3 separate single member LLCs, each having different clients, each having different receipts. So it kind of requires you get, really granular down to those, separate receipts and, different businesses to figure out who is doing what. So, so a couple of things just to point out, as if this may have come up in looking at New York State taxes or trying to figure out, how the UBT is different from New York State taxes. Again, with UBT or GCT, we're really looking at, what am I getting paid for? What services am I getting paid for? And where are those services performed? So there's a kind of separate question or an additional question here, which is that who is performing those services? And we'll get into that in a little bit, right? But it's, easy if you have a single member LLC, you have one person providing the services. But what happens when you have a larger company, a partnership, multiple partners, service providers, administrative people, you got to figure out who's doing what. There is no so-called convenience rule that applies to UBT or GCT. And what do I mean by the convenience rule? You know, people might have heard this term or be aware in the New York State context, we have this idea and law in New York that if you have W-2 employees whose primary office is in New York, but who are performing services from another state for their own convenience and not necessity, those wages are treated as earned in New York State, even if that individual is not physically present performing those services in New York State. So we could, you know, talk a whole other hour about that, but the point here is that doesn't apply in this context. In the UBT context and the GCT context, there is no convenience rule. So it is where those individuals are actually performing services. I will make one side note that just, you know, within the last month, New York City came out with a ruling regarding the REAP credit, which is an employment-based credit to encourage people to have employees and to hire people in New York City. And basically what the ruling said is that, look, if your office was closed due to COVID and you have people working elsewhere, you can still treat those individuals as, you know, working in New York City for purposes of this REAP credit. So, you know, helpful to taxpayers, but then it kind of throws in at the end, but you have to do that consistently for all tax types. Now, no one, you know, that seems to imply if you're going to do it, get the benefit of the REAP credit, you have to do it for, you know, UBT, for instance. I don't think there's probably any basis for that in the law, but it's just something to be aware of. In any case, you know, still, there's no convenience rule for purposes of UBT. And New York State, for its partnership rules, allocation rules, looks at kind of where the main office, what office you are connected with, kind of like this convenience rule. Again, that rule does not apply in the New York City context. We're really just looking at where the services are physically performed. But, you know, as I said, this can be a complicated question or a more complicated question if you have multiple service providers in a particular entity. The question is, you know, how do we do this math? Whose services do we look at?
Yeah, and let's come to that in just a little bit, Liz, but two things. I think one is, you know, from the perspective of the convenience rule, right? A lot of employers, you know, said, hey, I have somebody who's working out of New Jersey or from the Hamptons. And so there's no real benefit because of the convenience rule as it relates to employment taxes. But what I'm hearing from you is that basically that is not true as it relates to UBT, that if somebody was working out of New Jersey or from Hamptons, there is an opportunity to look at that and say, if for that portion of time, which was a lot last year and will likely be a significant amount going forward, assuming people are doing this hybrid 3-day office, 2-day away, or 2-day in the office, 3-day away, there is that opportunity to look at that and say whether there's an opportunity to save on UBT tax. So that's a really, really good. Thank you for making that clear. I do have a question from Joe. Joe, thanks for putting questions. So others on the call, if you guys have questions, please don't hesitate. Please do send questions. Very good question from Joe. So Joe's asking, hey, New York City GCT in past years, services were not allocable outside of New York City. Only the sales of merchandise was. When did this change?
So, so New York City, so for both UBT and GCT, the rule was changed, I think, in 2007. So once upon a time, it was just when, first they changed sales of tangible personal property. But this question of, for services, whether you could allocate within and without New York City if your only office was in New York City. I don't know offhand the exact year that changed, but that's been the rule for quite some time, that you can allocate within and without New York City, even if New York City is your only the only place where you have a physical office.
Okay. Joe, hopefully that answers your question. If you have any follow-ups, please don't hesitate to send those to me. Okay, so moving on, one of the things that I have had conversations with a number of asset management firms and other firms is this concept of who should be included in the calculation for New York City, UBT. Now, as it turns out, in a number of my conversations, the perspective seemed to be that it is just the key principle. So it's the owner and the other two folks who are on the investment committee, or the top 3 guys, top 5 guys, who basically should be a part of this UBT calculation. Maybe you can touch upon whether that is true or not true. And you and I talked about the recent ALJ ruling for GLG. So maybe you can shed some light on that, and what can we all learn from that?
Yeah, so that is a really important question, because I think until the case that you mentioned, and I'll go through it in some detail, we were kind of not guessing, but interpreting what little guidance there was out there as far as whose services that you look at. So, as I said, in the UBT context, we really have very, very little guidance. So there's really this, one finance letter ruling that sort of said, hey, not only do you look at for a particular receipt what services are provided within and without New York City, but if you have different tasks performed by the same entity for this same customer, right, and they're billed at different rates, or you have, different receipts billed at different rates, you can look at the time spent within and without New York City to accomplish the various tasks to come up with a methodology. So that kind of gets at, all right, as I said before, it gets very granular. You can really kind of dig in. And then we have this GCT rule in the regulations for GCT, which is, I have to say, previously having dealt with this apportionment issue for services on audit, this is, typically what we have looked to when we talk about a methodology. That is, there's a GCT rule that says when you get a lump sum in payment for your services, to figure out how much of that gets taxed by New York City, we look at the relative values of or amounts of time spent in performances of such services. So that it's that key phrase, relative value, that sort of gets at, all right, do we look at, we've had sort of interpreted that, well, who really brings value to, let's say, an asset management business? Well, is it just those, final key decision makers, as far as investments, or, kind of the way in which asset decisions are made. And, so then came along this case by Gerson Lehrman Group. And, it's helpful to kind of go through some of the facts of this, because that will be critical in sort of thinking about what do we take from this case in other types of service businesses like asset managers. And so I'll say that this case kind of started at the lowest level in the New York City administrative courts, which is the administrative law judge level of the tax appeals tribunal in New York City. Then it went to the next stage of the appellate administrative court, and then finally, very recently, was upheld in New York Supreme Court, the first department upholding the tribunal. So just to give a little bit of background, right? Gerson Lehrman sells a subscription-based service to its customers, offering kind of consulting services on a wide variety of topics based on what the client is interested in. But it's a subscription-based service. The headquarters of the company was New York City. That's where most of its sales team was. But it had other offices throughout the United States. It had research managers scattered throughout the United States. And then it used these so-called council members who were treated as independent contractors. So basically, if there was, someone wanted consulting on investments in the telecom industry, they would locate some expert in that field, bring them on as an independent contractor and connect the customer who had subscribed to GLG's services with this expert. So originally and historically, GLG had treated its services as primarily performed in New York City because it based on where its salespeople were performing services. It then filed refund claims and took the position that it's really just where the council members, because this is ultimately what its clients are paying for. New York City said no. It really is the salespeople, and even if we go beyond the salespeople, let's just look at all of the let's just look at the wages that GLG pays and where it pays them. So this went, as I said, to the lowest administrative court. And originally at the lowest level, the judge pretty much sided with GLG. It said, look, we think, not just council members, but also the research managers are really what should be included for whose services, right? Again, the question is, whose services do we include when we're coming up with an apportionment methodology of where the services are performed? That then got appealed to the Tax Appeals Tribunal, and the tribunal kind of came up with its own sourcing approach. It kind of came up with a methodology that wasn't what the GLG wanted, and it wasn't fully what New York City wanted either. It said, look, what GLG is selling is subscriptions to its services that are tailored to its clients' needs. So it's not just selling a consulting service, which is what GLG is saying. And it's not just a matchmaker between independent consultants and its clients, which is what the city was saying. It really said, look, in order for for these receipts to be earned, for GLG to earn its money from this subscription service, you kind of have a whole package that works together. That is, we have to look at these council members, the ones who are actually providing the consulting information. We have to look at the research managers who kind of worked with the clients, figured out what their question was, figured out which council member to connect them with, and then generated questions for the council members to answer. It also includes salespeople, because GLG wouldn't have any income if its salespeople didn't go out and find clients. And the tribunal said it also includes certain IT specialists, because this was primarily a web-based subscription, that by kind of keeping the research database, by making it easy to connect the consultants with the clients, the IT specialists came into the mix. So pretty much the package of services included a fairly wide spectrum of both employees and non-employees. And then it said, look, we can, let's figure out a methodology. You got to do the math. They remanded it back to the lower court. It then got appealed by GLG to the appellate division. It upheld the tribunal's decision just earlier this year, and that's kind of where that case stands. So, I've kind of gone through a lot of information about the case, but the case is really important in the UBT context, particularly as we'll talk about a bit more, when we have New York City based businesses where during COVID and most likely going forward, we have a lot of key service providers who are no longer performing their services within the boundaries of New York City. So this case is really important to getting out, how do we come up with a methodology to figure out not only where the services are performed, but whose services. So some kind of key context. As I said, historically, both from the practitioner side, but also from New York City on audit and letter rulings, they often, when the rules are the same in the GCT and UBT context, in UBT cases, we pull from GCT regulations and guidance. So I would assume that the GLG case, even though it's a GCT case, it will be used in the UBT context. Again, we're looking at the location of the individuals generating these charges for services. These don't just have to be employees, and that actually is in the GCT regulations that says we can look at third parties, non-employees. We can look at partners, right? It's not just W-2 employees. It's a wide range of service providers that contribute to the generation of receipts. Based on the GLG case, as well as what's in the GCT regulations, the GLG case didn't change the fact that we're not going to look at the location of back office administrative personnel, right? So even someone like general counsel for an asset management firm, that person's services probably won't go into the methodology because they're really not, directly generating the receipts. But there might be some service providers like, IT people that we might have previously thought of as more kind of back office administrative people that in some contexts could kind of be brought into the mix. The other question is, what about sort of this weighting? As I said, the GCT rules talk about when you get a lump sum payment for services that you look at the relative values of, right? So in GLG, they really just used payroll amounts, including kind of the amounts that were paid to the non-employee council members. But there could potentially be another methodology if it made sense in the particular business that is subject to UBT, and if it's consistent, right? So first and foremost, any methodology that's used to apportion UBT income or business income for UBT purposes has to be consistent, right? You can't sort of decide, okay, we're going to look at these service providers who just happen to be out of New York City, but people doing similar jobs in New York City, we're not going to include those, right? Not too surprising. You're going to need to be somewhat consistent in how you're looking at these different service providers.
Okay. That is good. Thank you for, I know that GLG is a big thing right now. I think it informs and hopefully brings clarity, right? In a world that otherwise, as you've said, has had very little precedence. And so people have been all over the place. So hopefully this brings some clarity as to how to think about it. Now, if you think about how do we translate this into the post-pandemic world, as you know, most companies right now are thinking about some sort of a hybrid work scenario, a few days in the office, few days out of the office. A lot of times the out of the office may be outside of New York City. It may be in Westchester, maybe in Long Island, maybe in New Jersey, maybe in Florida. So how do you think about this opening up opportunities to save New York City UBT? Maybe you and I talked about the best way to do this, maybe through an example. So can you walk through an illustrative example that gives sort of clarity as to how somebody may have thought about this pre-pandemic and how they may think about coming fall as folks start to going back into the office?
Yeah, absolutely. And what's interesting about this is we're kind of working with a lot of clients who kind of after the initial shock of when COVID hit, everyone fled New York City, and what does this mean? And then as time went on, and a lot of businesses, particularly when we're talking about somewhat smaller businesses, in the asset management industry, that for a lot of them, they could perform quite well with not having to be all in one office, right? So they started thinking about, do we keep our office space? For some asset managers who were changing their residency outside of New York, right? There was a question, do we need to kind of move the whole business? What about, for example, all of our administrative folks who aren't planning or can't just kind of up and move from New York, and eventually we'll be back in the office, or we do want to maintain a presence in New York City, right? So all these different things. And for some, even if it wasn't realistic to absolutely close a New York City office and say we don't need that anymore, right? There was something to be gained by even if New York City continued to be the only office going forward, that even by having certain service providers and principals working from home in another state, there could be some real New York City tax savings. So as you said, let's kind of walk through a scenario so we can kind of see on the ground what that would really look like. So consider a hedge fund management company. It's organized as an LLC, so it's subject to UBT. It's got one New York City office historically, two partners who are obviously service providers as well. You have 4 analysts who contribute to the asset management approach, and then 8 back office people. So, historically, everybody worked together in the New York City office. And so, you didn't really think about kind of apportionment for New York City. And then, March 2020, that office closed down, and it's been closed, and maybe it's going to open back up in September 2021, but kind of we'll see. So as far as where these individuals are, let's just all assume they're all working from home during COVID. So you've got one partner in Connecticut, one in Florida. You've got 2 analysts in New Jersey, 2 working from their New York City apartments. And so you've got $10 million in net business income that is subject to UBT. So again, historically, what did this look like pre-COVID? Basically, all services are performed in New York City. Maybe those partners occasionally travel to meet with potential investors or, something related to work, but it was minimal. No one really kind of thought about it. And because New York City was the only office where most of the work, where the services were performed, 100% apportionment to New York City. And again, using this sort of very simple example, about 400,000 in UBT. Okay, so what does this look like in 2020. As we said, mid-March through the end of the year, basically everyone was working from home. Both of our, partners in this example were their homes were outside of New York City. So, let's say, rough math, both of them worked approximately 260 days, 60 of those days in New York City. So again, even though I'm a tax lawyer, the math has to be very simple for me to work my way through it. So, each of these partners kind of has the same math here. And on average, during 2020, they spent 23% of their time performing services in New York City. Okay. Then what about the analysts? Again, because the math has to be simple here, they're all gonna, on average, work the same number of days. Our non-New York City folks are, like the partners, 60 days they worked in New York City. And the ones who are based in their Brooklyn apartments, whether they were working from the New York City office or from their Brooklyn apartments, they were working 100% of their time in New York City. So again, on average, if we weight all these analysts equally, 63% of their services in total were performed in New York City. Okay, so now we got to kind of put the math together. And so for purposes of simple math, we're going to weight the partners, the relative value of the partner services and the relative value of the analyst services as equal. So 50% weighting. So the partners worked on average 23% of their time in New York City. The analysts worked on average 63% of their time in New York City. We averaged those out because we're going to treat them as 50-50. Their combined apportionment is 43% of the services were performed in New York City. And when we apply that to the net income of the business, we end up with unincorporated business, 43% of 10 million at 4% tax, of just over $171,000 in tax. Remember, in our 2019 example, when we treated all of those services as being performed in New York City, the tax was $400,000. So that can, that's real money. And so I think when we all kind of realized that, that's how the rules played out in the context of lots of service providers no longer working in New York City, in the New York City context, we realized this could have a big impact. And a lot of businesses that were previously 100% New York City, or a vast majority of their services and income apportioned to New York City, started realizing that, not only are we rethinking how much New York City office space we need and the cost of maintaining New York City office space, but, our principals who, who have decided to change their residency, or the talent that we want to attract that live and they want to work in some other state, well, we can do that and really save on our UBT liability. So it has a real impact in the New York City context.
That is awesome. Thank you so much for showing that as an example. I think whenever you see that sort of in numbers that way, obviously it's illustrative, it's very rough, it's directional. Every firm has its own set of facts and circumstances. But the fact that you showed 20 million in management fee, right? You're talking about $1 billion hedge fund there, right?
Right.
2 and 20. Obviously, when you start to scale those numbers, if you're talking about, 5 billion, 10 billion, $30 billion, where you can see the amount of savings, it's quite incredible, actually. And, it's very interesting that not a whole lot of people have paid attention to it over the last year, but I definitely know that a lot more people are waking up to it now. There's also an important point that you made about, partners picking up and sort of becoming non-residents of New York State, New York City. I do have a question that actually Dan has posed, but I want to come back to it in Q&A. But just following up from this example that you have here, talk to me a little bit about how all of this works with respect to the New York State pass-through entity tax. So any analysis work for this tax? Does this all work with respect to the pass-through entity as well?
Yeah, so Nishant, as we talked about early on, because New York has different apportionment methodologies, tax regimes for every entity type. The application is unfortunately not the same for New York City taxes and the new pass-through entity tax. And I'm not going to get too deep into the weeds here, but just this year, New York State impose an elective pass-through entity tax regime. Again, like many other states, New Jersey, Connecticut, California is going in this direction, lots of other states, as a workaround to the limitation on the individual SALT deduction, federal SALT deduction to $10,000. So entity pays the tax at the entity level, individual on their personal income tax return filed in New York gets a credit for the taxes paid by the entity. The entity gets to take the federal deduction for the business tax expense, and everyone is the better for it. So, but in the guidance, right, New York State has said, look, you're going to use the same sourcing rules that a partnership or an S corporation would use in the sort of regular, sort of normal New York State rules. And because partnerships and LLCs, the entities that would be also subject to UBT, use a 3-factor formula, and because the receipts factor looked at where is the principal office location that the individual providing services is connected to by contract or reports to, right? It's not just based on where services are performed. This, the impact of telecommuting or principals changing their residency and performing services from Florida, for example, doesn't have the same impact. Now, if that, partnership then closes its New York State office, so there's no office in New York State, that may be a different analysis, but generally, as long as there is some New York office for the entity that's maintained, it's this benefit that we see in the UBT GCT context is unfortunately not the same for the pass-through entity taxes.
Okay, awesome. Thank you for clarifying that. Now, with all of that, the next question is, what are you telling clients? Obviously, there has historically not been a lot of guidance, and you've got the GLG case. People are just waking up post the pandemic. Folks are now starting to come into the office. Some folks will be in the office, others will not be in the office. Part-time, yes, part-time, not. Is this all too complicated for folks to look into this? We did the math. It looks like the math looks actually pretty good. Why would we not save more than half of the UBT? So what is your guidance? Should firms be taking advantage of this opportunity to save UBT?
Yeah,
and if yes, sorry, let me just
go ahead.
And then if yes, then what are you telling them? Because what are you telling them that they need to do to be prepared? Because you and I both know we've been doing residency cases, New York City residency cases for a decade, right? You and I have been doing this for a decade, and we know that New York is aggressive. And I can't believe that firms start to take a position on UBT where they're saving more than half on the UBT, and New York City just sits there quietly. So what is your guidance around, should firms be doing this, and what should they be doing to be prepared if they do decide to take advantage of this?
And Nishant, I think you hit the nail on the head, right? The savings, the UBT savings are real. So there is a real benefit to, if you have your, principals or, a large number of your service providers who are performing their services outside of New York City, and particularly if they intend to do that going forward, I think there is an absolute benefit, of taking this approach. However, you do have to be prepared for an audit, because New York City is only getting more and more aggressive in the UBT context. You know, I'm probably handling a dozen UBT audits right now, not all in the you know, this allocation apportionment context, but you know, quite a few of them, yes. And you know, as the taxpayer, you are going to have the burden of proof to show not only why the methodology you used is consistent with the law, but how you did the math, right? So that's, you know, sort of what I'm cautioning clients is, look, you got to be prepared, right? You know, figure out the methodology that you're going to use when you file your tax return, have the data to back it up, and, you know, be prepared for an eventual audit, because as you said, someone going from paying 400,000 in UBT to 170,000 in UBT, that's a red flag for New York City right there. Okay, so that gets to the question of, okay, well, how do you do the math? What are we telling our clients? And look, I think there are ways of differentiating between the facts in the GLG case, right? The fact that it was a subscription service, that for example, the IT people that were brought into the methodology, right? That's because it was a web-based subscription service, and you know, they kept a database but you know, this is a fact-specific inquiry. And so what the GLG case says is, look, you have to look at all of the service providers who contribute to generating income. So that could, for example, if you have an asset manager that relies on, you know, algorithms, or, you know, you know, various technologies in investment decisions, then, you know, your key IT people who help, you know, maintain that and make it function may be includable in the methodology. So I think that the takeaway from the GLG case is, don't assume you can just use your primary decision makers. Most likely it's going to include your, you know, research people and analysts that are part of, you know, putting together the information that is used in making the decisions. And it may include some additional, you know, people, depending on what the services are being provided. But the back office people, the bookkeeper, the general counsel, the office manager, those people's services are not going to be included. The second thing is, in coming up with a methodology, you know, you can weight people differently. You know, audit may question that. I think audit likes a more sort of straightforward approach. And look, compensation might get to weighting a principal decision maker differently than an analyst, but there might be some other methodology that you need. But the third piece of this, you know, which is kind of where you come in, Nishant, is that, look, if you're going to say that this individual provides, you know, 63% of their services outside of New York City, you better be able to prove it, right? If you're going to do it based on, you know, time spent in one location versus another for all of these individuals, you really need a method of contemporaneously tracking their time. And it's not going to be good enough to just sort of have a spreadsheet where someone says, hey, I was working outside of New York City for, you know, I worked 280 days, and, you know, 200 of those days were outside of New York City. That's not going to be enough. You're going to need some type of third-party documentation that makes clear where that individual was located when they were performing services, along with kind of a calendar that shows, you know, what are work days. So it's a lot of work, right? And so Nishant, I don't know if you want to kind of talk a little bit about, what can make this record keeping maybe a little bit easier when we're trying to figure out where services are performed.
Absolutely. Thank you for that, Liz. So yeah, I mean, I've been doing this now for almost a decade. I built this application, which some of you may be familiar with. It's called Moneo. It's now called Topia. And, essentially, as Liz said, one of the important ingredients in this is going to be able to prove in an unequivocal way where are people spending time. And this can be a lot of work if it is done manually. Also, the nature of the audit is very different when it is record keeping done in Excel files, on calendars and diaries. And how do you do this in a diary or an Excel file when you have, not one person, but 20 people, 50 people, 60, 70 people who may need to be a part of this calculation. And so there is technology that's available out there. I built this application that runs on people's mobile devices, on their laptops, basically keeping record of where individuals spend time when they're performing work. And that can basically feed into these calculations for UBT purposes. I'm happy to obviously talk more to anybody who is interested in that. In the last 2 minutes, Liz, I have a very interesting question from Dan that I would love to ask you. And this has come up in a number of my conversations. So obviously, as a part of this pandemic, and even before that, a lot of people have left New York City, right? I mean, especially the top guys and girls, they may have moved to Florida, or they may have moved to Texas or somewhere else. And so the question is, if you are a New York City resident and made the New York State S-Corp election, then are you double paying taxes to New York City, both at the personal level as well as the entity level? And then what happens if you left New York City?
So, I mean, I think that the answer to that is basically yes. So if you are a New York City resident, so you're paying that extra 4% tax, and you have a federal S corporation that now has to pay GCT, you don't get a credit. New York City residents get some credit for UBT, like a 35% credit, but not for GCT. So if you then move out of New York City, right? You're no longer, New York City only taxes at the personal income tax level, only taxes its residents. So then you're saving that 4% city tax. And then there could be significant savings on the GCT level as well, depending on sort of how that methodology gets calculated of where services are being performed.
Awesome. Liz, we're at the mark. I feel like we could keep having this conversation. Those are the best conversations where you lose track of time. There's so much more that I want to talk to you about today, but hopefully the audience got a lot out of this. And if anybody has any questions for Liz or for myself, we'll make ourselves fully available. Please don't hesitate to reach out. We will be following up with a recording of this session as well as the slides, and here to answer any questions that anybody may have. Thank you very much. Thanks for joining us.
Thanks, Nishant. Thanks, everyone.
Thank you, Liz.